showing up. And this paper, I think it's more his paper than my paper. So he came at it more from a cumulative risk premium. I came at it more from, if you have a log normal distribution of returns, that's very special. And it's so special it can be misleading. He came at it, I think, from the well, let's look at what's not so special, non-log normal returns, and use cumulants to describe those. So I'm going to go through these slides where first it's motivation, and then we'll talk about, I would call it the theory, and then we'll talk about what I would call the empirical part of the paper that Karamfil did basically all the empirical work, and then we'll talk about the economic implications. So a theme of research that's existed in the past is, how do you measure the risk premium that's kind of associated with higher order moments? So people have talked about a skewness premium or a kurtosis premium or something like that. And to measure it empirically, what has typically happened is that researchers construct returns based on option portfolios. And then they look at the realized returns on these option portfolios and maybe compare them with beta hedge returns, or just essentially try to compare the physical distribution with the risk neutral distribution empirically by looking at option returns. But one of the problems with using options is that options aren't that liquid. And because they're not that liquid, it's kind of hard to measure the returns, because you don't know where a realistic trading strategy would be able to buy or sell. So, the huge bid-ask spreads sometimes, like 74% for deep out of the money options. So what we're going to do for the empirical part of this is we're going to use leveraged ETFs. And a leveraged ETF is exactly what it says. It's an ETF where there's a kind of pre-specified amount of leverage built into it. So, for example, on a 2x levered S&P 500 ETF, you would expect that if on a given day the S&P 500 went up by 1%, and your return from holding the spider, something like that, would be plus 1%. The leveraged ETF is going to give you a return of something like plus 2%. And if it's a 3x levered, it'll give you a return of plus 3%. And if it's a short ETF, might be 2x short, it could give you a return of minus 2% when the market goes up, and it'll make money when the market goes down. So the advantage of using these leveraged ETFs is that many of them are fairly liquid. And in general, they're much more liquid than otherwise similar options. Bid-ask spreads being not that many basis points, comparable to the bid-ask spreads that you would see for stocks. Another advantage is that these leveraged ETFs are conceptually easier to replicate than an options payoff. With an options payoff, the beta is constantly changing, or the delta, I should say, on the option is constantly changing, and you have to estimate what that delta is, and it becomes a little bit complicated. But with the leveraged ETFs, the strategy is pretty straightforward. Nevertheless, there's some interesting issues that occur with the leveraged ETFs when they try to replicate their benchmark strategies. So if you're a 3x, let's say, long ETF, and the market moves up, you're going to make a much greater return than the size of your actual position has increased. And so at the end of the day, you need to rebalance, and you rebalance by buying after the market goes up. Similarly, you rebalance by selling after the market goes down. What a lot of people don't realize is that if it's a short ETF, it doesn't even have to be leveraged. It's -1 but -2, -3. The short ETFs actually don't have the opposite property of the long ETFs. They have the same property. That is, if the market goes up, you have to buy to rebalance. If the market goes down, if the market goes down, you have to sell to rebalance. And this is because the payoffs essentially on both the leverage and both the leverage long and the leverage short ETFs have a convexity property. So it's a kind of conceptually clean way of buying convexity. So the dynamic rebalancing strategy of the leverage ETFs, the main point of our paper here, is this dynamic rebalancing strategy of leverage ETFs, buying when prices go up, selling when prices go down. It's kind of a momentum strategy. It exposes them to higher order moments. And since it exposes them to higher order moment risk, we can try to ask, what is there a risk premium associated with these higher order moments, and can we measure it? So just this is supposed to be for motivation, and there's a typo in this slide. It says, if you could look at the difference between the actual return and the log return, that difference is the sum of the returns raised to the nth power with an alternating sign divided by n. It's not supposed to be n factorial. And some examples of these returns that you get for S&P 500 and treasuries and natural gas and oil with various positive leverages are shown here. So that the one interesting fact is that these returns tend to be positive, and that's because, to a large extent, shorting variance is profitable. But the other thing to notice is that they are the R is different from the log of 1 plus R. And most importantly, for our purposes on this paper, if you compare the benchmark, which is a leverage of 1, with the actual ETF, which in this case is a leverage of 3, the blue lines that measure the higher order moments are magnifications, if you will. They look kind of like magnified versions of the red line, but the magnifying factor is more than a factor of 3. And as we're going to point out, it's more like 3 squared rather than 3. The way these things work. Okay, so I'll go to the next slide. So there's this common misperception that when you do some kind of Taylor series expansion, not the log one I did on the previous slide, but a different one, you get these terms that involve 1 over n factorial. And it's a common misperception that because you get these terms involving 1 over n factorial, the higher order moments are just going to disappear. And that's true if you're talking about a beta of 1. But if you're talking about a higher level of beta, like a beta of 3, you really need to realize that these higher order terms have a beta to the nth power that you see here. And that beta to the nth power means that these higher order terms are becoming quite important. So hypothetically, if you had a beta of 10, these higher order terms would potentially increase in importance all the way out to about n equals 10. Whereas with beta equals 1, they do indeed, as the first plot shows, die out really quickly. Okay, so what are we going to do in this paper? We're going to introduce something that we call the cumulant risk premium. And you can think of this as the difference between physical and risk neutral cumulants. So cumulants are going to be associated with probability distributions. I'll define them in a minute. But it's a way to think about measuring the difference between the risk neutral distribution and the physical distribution, and summarizing it in what we hope is a useful way. And we're going to make the point that these leverage strategies, just like the previous couple of figures have illustrated, these leverage strategies, they leverage themselves up linearly with respect to, let's say, the risk premium you get from just the first order term involving the mean. But they leverage themselves up with these higher powers, like beta cubed, when you want to measure their exposure to higher order moments. And so, we think that there are a lot of interesting things that go on in finance that are associated with these higher order moments. Many investment strategies, like take a look at a hedge fund. Many hedge funds, if they're making money, they're just going to expand their strategy. If they're losing money, they're going to shrink their strategy. And that alone gives them exposure to higher order moments. You see it in financial crises when they have to delever. And you saw it in the 2008 financial crisis, for example, when the hedge funds that were betting on mortgages that had really high leverage, like 3 to 1, 6 to 1, 10 to 1, even more, they started blowing up when the mortgages started shrinking. momentum strategies are the same way. If you're following a momentum strategy and you're making money, you kind of increase the size of your positions by buying as prices go up and selling as prices go down. And that gives you exposure to these higher order moments.
So let me jump in. So there are a
Yeah.
couple questions in the chat that are basically come down to, isn't the tracking error on these leveraged ETFs large? And, does the fact that there's a lot of tracking error matter, and how important is it?
Oh, this is a good question, and we've gotten feedback from our referees about the same issue. So the leveraged ETFs might have a hypothetical target strategy that says that they effectively would like to trade exactly at the closing price every day to do all of their rebalancing. So, they would come into the day with a given position. And then if the market goes up 1% and it's a triple levered long ETF, they will expect to make a return of 3%. So that means they need to come into the day kind of with the 3 times levered long position. At the end of the day, if the market has gone up, they will find that they need to increase their exposure by buying securities to have the right 3x exposure tomorrow. So the question is, when do they actually increase their exposure? And the answer, theoretically, according to some of their benchmark strategies, is that they would theoretically want to trade exactly at the close, whatever quantity it takes to do that. Well, how big of quantities are we talking about? Well, uh, many years ago, one of my PhD students took on Tuesday and wrote a nice little paper about this. And there have been some other papers written about it. And they show that actually a very significant percentage of the volume around the close theoretically would be these leveraged ETFs rebalancing. And if they did all their trading on the close, they might overwhelm the close with gigantic quantities that would trigger a huge amount of temporary price impact that would probably go away the next day, and that would act as a drag on their performance. So what they in fact do is they in fact typically don't do all their trading right on the close, but they wait a while to see whether the day is going to be an up or a down day. And then when they get to be later in the afternoon, they will start buying if they need to buy or selling if they need to sell. And that I think the reason they would do that is that the temporary price impact costs associated with spreading their trading out over, say, the last hour of trading are going to be lower than if they tried to buy everything in the last 1 minute of trading or everything on the closing auction. So then to get back to your question, how do you think about the tracking error or the deviations from what their benchmark is? There's several different issues that come up. One is, how do they manage their price impact? The price impact's important. Number two, they're actually affecting returns because they're having the price impact. So a paper trading strategy might accurately describe something that's very, very tiny, but it wouldn't describe a really big ETF. And so they have to manage their trading costs in a way that's going to create randomness, because they may start buying at a particular point an hour or two before the close, and the market might do something unusual, and they may wind up with returns they didn't anticipate. Another problem, so then you might go to the opposite extreme, and the opposite extreme would be, why don't they just rebalance continuously throughout the day starting at 9:30? And my answer to that question is, that's going to be way too expensive from the perspective of transaction costs. So that means they're going to wait. But they still have the problem that if there's a discontinuity in prices and they're trying to do something that approximates a continuous trading strategy, they can't do it. They can't hedge through the discontinuity perfectly, as we all know, because the price jumps and they should have been buying as it was going up or buying as it was going down. But they can't do it because the price changes so fast. It doesn't have to be an actual discontinuity. It could just be the price is changing really, really fast. And if they had to trade really, really fast, they would have a huge amount of price impact. So I think a lot of it revolves around price impact. Okay. Did I answer that question? Sort of.
Let the people who asked to jump in with a follow-up if they have it. But I guess there is a follow-up question. What about the strategy of using a futures contract on the index?
So you can use a futures contract on the index and you can rebalance it however you want to. And if you do, your strategy will be exposed to these higher order cumulants. And there's no guarantee that two traders trying to implement the same strategy will actually get the same returns. And we saw this big time in the crash of '87, where the portfolio insurers, like LOR, Leland O'Brien Rubenstein, were not trading options because they thought the transaction cost of trading options would be ridiculously high. So they tried to replicate the option portfolio, and the replication of the option portfolio had the similar properties as these leveraged ETFs. So they would try to, except they would do it more like ex post rather than ex ante. They would wait until the next day and then try to rebalance their portfolio to replicate the option. And ultimately, it created higher order moment risk. That's part of the economics, but ultimately also they they had to bear the cumulative risk premium that was being created, and that cumulative risk premium probably wound up being unfavorable for them because maybe they were trying to buy options, but the reward was in the opposite direction at that particular time. So you could try to use futures contracts and just dynamically rebalance, but different traders trying to use the same futures contract to dynamically rebalance are probably going to get different results because sometimes the futures market moves really quickly, and you're not really able to trade through those rapid movements, and so you trade more slowly. But different traders are going to trade more slowly in a different way. But there's a history of it. You have the commodity trading advisors historically have been kind of trend following types of traders, and they're therefore generating high order moment risk for themselves.
All right, there's another follow-up question, but I think I should let you move on because I think people can argue with you at a later point in your talk.
Okay, maybe they can argue with Karamfil if he's here. So, okay, I'm going to keep going. So when we look at the leveraged ETFs and try to measure this cumulative risk premium across some equities, bonds, commodities, currencies, and even volatility itself, we find that typically it's not always negative, but typically it's a negative. A lot of that is just shorting volatility tends to be a profitable trade, but it also has some higher order cumulants in there as well. And we also find that if you construct an index of global market stress, which would be a kind of average of all of these cumulative risk premiums. And when you do that, we think you get something that's at least as good as VIX and probably better, perhaps because it can be tailored to whatever economics you want to tailor it to. Okay, so let me go on and talk about leverage cumulants and what we call linear beta pricing. So if you think about how do you implement a leverage strategy, one way to do it is what we call a static strategy. You want to be 3-to-1 levered. Levered, you borrow $33.33 for every $100 you want to. Excuse me, you invest $33.33 of your own money. You borrow the rest, and buy your $100 worth of the asset, and then just hold that and see what happens. And that happens in futures trading. And in futures trading, a lot of times you make money and a lot of times you lose money. If you lose money, you either have to liquidate your position, which is giving you this higher order moment risk, or you have to put more money into your account. And the problem here, of course, is if you don't rebalance, which a static strategy implies, that would be implying you're putting money into the account or you're not putting any money at all. If you don't put any money into the account and you don't rebalance, then you expose yourself to bankruptcy risk because the exposure beta of your position will be changing. If you go long and you lose money and you don't rebalance, you don't put money into your account, your beta starts skyrocketing. Eventually it goes to infinity, and eventually you become bankrupt if the market moves against you. If the market moves up, your beta goes down, and if it moves up enough, you start approaching a risk-free asset. So the alternative to that static strategy is dynamic rebalancing, which is kind of what the leveraged ETFs do. And in continuous time, the dynamic rebalancing just says if P is the value of your asset that you're creating, using leverage, then the change in the value of your asset with as a percentage is going to be beta times the change in the underlying, where the underlying's got a beta implicitly of 1 here, and your asset's got a beta of say 3. So that's kind of what that's kind of what leverage ETFs try to do. And one of the things it does is it reduces bankruptcy risk, since you're constantly rebalancing. You're maybe keeping the leverage at 3. You can make money, you can lose money, but as long as you can rebalance fast enough, and as long as prices are continuous enough, you're not going to face bankruptcy. Of course, if there are jumps and the market falls 50% in one jump, you're going to be bankrupted with a beta equals 3 strategy. So our thought is that these kind of strategies expose you to higher order moments because they change the shape of the return during the period that you're rebalancing. We can think of that period as being like a month or something like that. And it changes the shape of the distribution of the returns you earn over that month. Okay, so we're going to try to get at this using the cumulant generating function. And the cumulant generating function it's basically another way of expressing the moment generating function. It's just a log of the moment generating function. So if you look, if x is any random variable, the definition of the cumulant generating function is here. It's the log of the expected value of e to the beta of x. So what we're going to do is we're going to think of x as being something like a log return. And so if beta is 1, e to the x will be something like a gross return. It'll be like 1.03 if the market goes up 3%. And then the log of that will be the log of 1.03, be approximately 0.03, but not exactly. And when you take the expectation operator in here, the log of the expectation of e to the beta x can be expressed as a power series for lots of distributions. And the power series converters for lots of distributions, and the coefficients in the power series that are typically called kappa are called the cumulants. So the sum starts from n equals 1 and goes to infinity. So kappa 1 is just going to wind up being the mean, the log mean of the distribution. Kappa 2 is going to wind up being the variance. Kappa 3 is going to wind up being the skewness scaled by the standard deviation cubed. Kappa 4, which is not here, is just the excess kurtosis. It's one way to kind of think about why excess kurtosis is defined the way it is. And you go up to the when you go up to the higher order cumulants beyond 4, 5, 6, 7, 8, 9, 10, they tend to become kind of complicated functions of the underlying moments of the random variable. But one case in which they don't become complicated, and they're particularly nice, is the case where x is a normal distribution. And that's going to be a case that corresponds financially to the case where the returns of the unlevered asset are log normal. And that's a good benchmark case that we use in finance quite a bit. And in the case where the log returns of the underlying random variable are normally distributed, the cumulant generating function only has 2 terms. So there are no higher order cumulants. And this is one of the features of a cumulant generating function that makes all this very interesting. And it's also the angle, it's related to the angle that got me interested in this. So I got interested in this because I think the log normal distribution is very special. And indeed, this is exactly why cumulant generating functions can be used to kind of illustrate how special it is. Indeed, the normal distribution, which is log normal when you make e to the x, the normal distribution is the only distribution that has a finite number of cumulants. All the others have like an infinite number of non-zero cumulants, kappa. So normal distributions are really, really special, really, really convenient, really, really nice. And in my opinion, what got me into this is it gives us, in some cases, really bad intuition because sometimes we think that the intuition for log normal distributions generalizes everything. And in fact, it doesn't. Okay, so why would we use cumulants? Well, they're more convenient to work with than higher order moments, as the normal distribution illustrates, but other distributions illustrate as well. They're easier to work with over multiple periods. So, for example, if you have returns that are IID over time, let's say over several periods, the cumulative generating function inherits an even simpler version of what the moment generating function has. We know the moment generating function of the sum is the product of the moment generating functions for independently distributed random variables. So with cumulants, it's the sum of the cumulative generating functions because they're the log of the moment generating functions. So that's one of the convenient factors. But it also makes it easier. It's pretty straightforward to do things like jump models. And so those are the advantages of working with cumulants. So we didn't put down here the disadvantages of working with cumulants. One of the disadvantages of working with cumulants is that in general, it becomes rather hard when the returns are not IID and they're like state variables that are changing in the background that prevent the, that make the returns not IID. And then when you want to calculate cumulants over multiple periods from the cumulants over shorter periods, by adding them up over time, they don't add up because the returns aren't independently distributed, and doing the calculations becomes more complicated. Okay, so what do? We define what we call the cumulant risk premium as the difference, mimicking what people in options do, as the difference between the cumulative generating function in the physical measure and the cumulative generating function in the risk neutral measure. And so that's just going to make it the sum of the same power series, except now you've got the differences of the cumulants in the denominator, in the numerator, rather than the cumulants themselves. And so if the risk neutral distribution has lots of cumulants that are different from the physical distribution, which is, we think is typically the case, then these higher order cumulants will wind up influencing expected returns. Keeping in mind that there's some math that we didn't put in here, but let me just summarize what the issue is. The issue is that with beta equals 1, this e to the x is like a return if r is a log return. But if beta is equal to, say, 3, e to the 3x is not exactly a return. It's off by some kind of constant. But we think that when you subtract the risk neutral cumulants, these constants will kind of be adjusted for properly, and that enables us to think of the risk premium this way. Okay, so this means, so let me keep going. So then we have a concept that we call linear beta pricing. This got me interested in this, and that is when I used to teach MBA students back in the days when you could teach MBA students complicated things, or even if you couldn't, we would teach them that you discount cash flows. Not you put the expected cash flow in the numerator, and then you do the risk adjustment in the denominator. And the typical risk adjustment implied by the CAPM would be to use the beta times the risk premium on the market portfolio, add that to the required return in the denominator. And that to me is linear beta pricing. When you're teaching MBA students, you typically do it in discrete time. But if you're going through something like a Merton model of continuous time CAPM, then it's a continuous version of the discounting. And indeed, those Merton models that have log normal distributions, they give you the continuous time CAPM, and they give you what we would call linear beta pricing, meaning that there's an adjustment of like e to the minus beta times the risk premium on the asset times delta t that shows up in the discount factor. So that's linear beta pricing. And if you compare the difference between the static strategy over, say, a month, it's not where capital T is like a month, it's not rebalanced, and the dynamic strategy that is rebalanced over that month, you can ask yourselves, when do you get linear beta pricing like we know you get when you're working with a Merton model? And the answer is when the cumulative risk premiums are the same. And that would mean if you take the cumulative generating function for this beta, high beta, say 3x long strategy, and compare it with the beta equals 1 kind of buy and hold return on the asset, they're going to have the linear beta pricing is going to say, well, multiply the risk premium by beta. But that ignores all these higher order cumulants. And so, or at least doesn't ignore them, but it shows up in a way that you might appreciate this next equation. So on the left-hand side, you get the sum of all of the cumulants, but in the numerator, the weighting is beta to the n. On the right-hand side, you also get the sum of all the cumulants, but since it's not rebalanced, you just multiply it by beta. So there's a difference here of beta to the n minus beta. It's obvious if n equals 1, which means we're talking about the mean, essentially, the first cumulant, they're going to cancel because beta 1 to the n is equal to 1. But for the higher order cumulants, it doesn't necessarily have to cancel. So we define the cumulant risk premium is the difference between the high order ones and the risk neutral cumulants. So it's a sum that starts from 2 and it goes to infinity. And it's got the difference between these physical and risk neutral cumulants divided by n factorial. And so linear beta pricing is only going to work if these cumulants weighted by beta on the right-hand side here and weighted by beta to the n on the left-hand side here actually cancel out. And that's the equation you see towards the bottom of the page here, where it's the sum from n equals 2 to infinity of the difference between the risk neutral and physical cumulants multiplied by beta to the n minus beta. So for the unleveraged strategy, beta equals 1. None of these higher order cumulants matter. But for other types of leverage, whether long or short or greater than 1, they generally do matter. And they even matter for things that are like 60% stocks and 40% bonds, shows up with a different sign. So the returns on leveraged ETFs have in them this cumulative risk premium. They have which is the difference between the cumulative risk premium on the strategy you're actually following that involves dynamic trading, and the more static strategy that doesn't involve any dynamic trading, but that you could multiply by the leverage factor beta. Okay, so just to illustrate what I'm talking about, in the nice case, which is the Black-Scholes world, of course, coming back to this previous slide, in the Black-Scholes world, we have the log returns are normally distributed, so only the first 2 cumulants are non-zero, and the means cancel out. So the second cumulant would be relevant if in the Black-Scholes world, the risk neutral variance were different from the physical variance. But we know in the Black-Scholes world, the risk neutral variance and the physical variance are going to be the same, because otherwise there's an arbitrage opportunity. So all of this doesn't matter in the risk neutral, in the Black-Scholes world. And indeed, when you look at the risk premium that you get, the cumulant, the difference between the cumulants and the physical and the risk neutral measure, the only difference that's relevant is the one in the mean, and that shows up as a risk premium that's a straight line, and that risk premium that's a blue straight line here is basically saying linear beta pricing works fine in a Black-Scholes world. And my interest in this is basically the idea that it only works fine in the Black-Scholes world. But then if you look at other assumptions that are not Black-Scholes, it doesn't work at all. So for example, you can look at a Heston stochastic volatility model. And when you look at the cumulative risk premium, it winds up having all of these terms in it. The variance risk premium is there. It turns out to be 0 when beta is equal to 1 for the unlevered asset that has stochastic volatility, but it turns out to be there for other degrees of leverage, excuse me. And all these higher order cumulants are also there. Similarly, you can have a model with jumps. And if you have a model with jumps, it's fairly easy to write down what the cumulant generating function is, because that's kind of tractable. And with the jump model, you've got arrival rate of the jumps and the size of the jumps and the variance of the jumps, so it can become kind of complicated. But in an example of a jump model, here you've got a difference, a cumulative risk premium that's highly nonlinear. And in the Heston model, you have a cumulative risk premium that's also highly nonlinear. So these are examples where the higher order moments do matter. And the cumulative risk premium does matter because of the way the higher order moments show up in the returns over a period of time, let's say a month. Okay, so the larger the absolute value of the beta, the more of the exposure you get to the higher order cumulants. And that's because when this expansion that I've shown you previously, you've got beta to the nth power. So if you've got leverage at 10 to 1, it winds up being really huge. So this is the same picture that I showed you in the introductory slides, that if it's an unlevered asset, these high order cumulants die out really fast. But if it's a highly levered asset, they don't. They actually multiply over as you go through the Taylor series expansion. And, this number here is 2,500 for a beta equal 10, as opposed to something that's essentially 0. So they become, the high order cumulants potentially become much more important. And that doesn't matter in the log normal world, where since the log returns are normally distributed, all those high order cumulants are 0. But it does matter in a world with jumps and this Heston stochastic volatility model, or in other kinds of models where returns are not normally distributed. So let me keep going here. So we can use the exposure on the constant beta assets to focus on one interesting case. And the interesting case is looking at the even order cumulants only. So let's look at variance, which is one of the first even order cumulant. And let's look at kurtosis, which would be the next one. And if you engage in what you can think of as a market making strategy of selling when the price goes up and buying when the price goes down, by essentially providing liquidity to other traders, this even order cumulants is kind of a proxy for what a market maker would earn if they shorted a levered long a levered long ETF, and they also shorted a levered short ETF that maybe had the same beta, so maybe the beta risks cancel out. If they do that, they are actually doubling up on the even order cumulants. And if the even order cumulants have a negative risk premium, that market making strategy should be profitable because you're betting, you're shorting both of them. So you're betting in a way that's kind of against the even order cumulants. So this, we think, is a pretty good, these even order cumulants are a good way of thinking about how important these cumulants are, and also mapping it into the idea of market making. So we construct a really simple short both strategy, which is to sell the constant beta assets with opposite betas. Now you could argue that we should have done it with +3 and -2 somehow, but it doesn't matter that much. You just have to weight it properly. And when you do, you're doubling up. So that's where the -2 is. You're doubling up on the even cumulants in your betting.
So let me ask a question I've wanted to ask for a while, and I
Mhm.
acknowledge that there's a lot of equations on these slides, and I really can't keep up.
Okay, even more equations.
Maybe you can straighten me out.
Yeah,
So
okay.
I'm thinking if there are no transactions costs
Mhm.
and no tracking error, then of course there's a whatever I'll call a delta equivalent replicating portfolio to each of these leveraged ETFs.
Mhm.
So Ray, so I'm thinking let's suppose I rebalance once a day. So
Mhm.
I'm thinking the expected return today should just be the expected return on the delta equivalent replicating portfolio. Are you saying that it's different from that?
It's different from that if you're continuously rebalancing during the day. So let's think of it over a month. if you rebalance every day during the month, let's even at the end of the day, or maybe you're rebalancing continuously every day, you definitely get a return that has uh, 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 um, that's influenced by the higher order moments. You know, the moments of your return distribution are going to be different from the returns that you'd have gotten from, say, a log normal if you started with a log normal. And if the original returns were indeed log normal and you rebalanced continuously or rebalanced once a day over the month, what you said is exactly correct, that the expected returns that you'd be expecting to get would be exactly what you would predict from linear beta pricing, because linear beta pricing works for log normal distribution. But if returns are not log normally distributed, and you have a kind of odd, you have a leverage position that you're undertaking, then you're actually have a risk premium that is going to be affected by the high order moments. So a good example would be the Heston stochastic volatility model, where I think the standard version of the model, there is no premium associated with volatility. But in the equations I just showed you on the previous slide show, it does matter if you have a leverage strategy on an asset that follows this Heston stochastic volatility model. Then the variance risk premium actually it actually shows up, because the variance of the underlying the variances can be kind of different in the Heston stochastic volatility model between the risk neutral and the physical distributions. So I find it very counterintuitive myself, and I keep asking myself exactly the same question you just asked.
Well, anyway, I'm not keeping up with you, but I need to let you move on, given
Okay.
the time constraints.
Okay, well, the rest of it is empirical, so I would prefer for Karamfil to present all of this, but I will try to show you what we did. So what we did is we looked at daily returns on these leveraged ETFs, but then aggregated the returns up to months. Um, and then we asked ourselves, well, what is the contribution of the higher order cumulants, third and above? So not even just the variance is actually the dominant one of the higher order cumulants, but what about the ones beyond? Variance is very important. What about the ones beyond variance? And the answer is that the ones beyond variance actually are important for the leverage strategies, even when they're not that important for the unlevered benchmark strategy. And you see it in this picture. If you're levered 3-to-1 and the fourth cumulant matters, it's going to show up as being basically 3 to the 4th power times as important as it would be in the unleveraged strategy. So that's 81 times more important. So you see these higher order cumulants really showing up, like in the 2020 COVID panic, showed up in the global financial crisis, showed up in the Euro crisis for stocks. And the same thing showed up in treasuries, that longer dated treasuries, big high order cumulants in 2020, and also in the Euro crisis. So when you look at commodities, there are more pictures in the paper, but they're similar. They're these episodes where the higher order cumulants suddenly kick in, and these episodes tend to be periods of high volatility. But that's not what these pictures are. These are pictures of the higher order cumulants in the second, that would be volatility. But these higher order cumulants also kick in when the volatility is very high. So you might ask yourself, is this cumulant risk premium positive or negative, and how important is it? And so what Karamfil did is constructed this nice table where the rows correspond to all different kinds of assets, and the columns correspond to all different kinds of leverage. And the rows tell you what the risk premium is associated with it's the cumulant risk premium. So it's a risk premium on everything except the first moment will have canceled out. And what you find is that a lot of these cumulative risk premiums, even though the time period we're looking at is not all that long, they're statistically significant if you're not real careful about how you measure statistical significance. So maybe we should be, maybe you could spend a lifetime trying to think about statistical significance here, especially because this is about high order cumulants, and the high order moments will affect your test statistic. But what I see is they're economically significant. On the S&P 500, you find that the positive cumulants tend to have a positive reward, but it's not that large. It's like 100 basis points annual, 100, 140 or 130 basis points per year. So it's quite small. And the short cumulants tend to be, the short cumulants, here we are. The short cumulants tend to be quite unprofitable. So, shorting the S&P 500 doesn't make you money. Even though going long with leverage makes you not only the equity risk premium that you get times 3, but you also get a modest positive cumulant risk premium. If you buy the short ETFs, you not only lose the equity risk premium times 3, but you also lose the money you would make from going the other way and shorting the leveraged short ETFs. This is from the convexity that they have. The reason there's an asymmetry between the long and the short, I think, has to do with the way the second moment shows up here. If you look at the rest of the table, you'll see that equities are something of an exception. That throughout the table, most of the cumulative risk premiums are negative. In the case of VIX, they're substantially negative, and they're in some of the other assets are substantially negative as well. And that is telling you that shorting these leveraged ETFs, that is, whether they're long or short, is allowing you, would theoretically be allowing you to profit from these higher order cumulants. And, especially even the cumulants above the second, which would be betting against variance. So highly profitable to short these things, except for the equities, where you got a positive here and there, a few other positives sprinkled throughout this table. We've also got some pictures in the paper that are based on rolling windows, just like how would a kind of something like how would a hypothetical trading strategy have done if you implemented it for a year, beginning at various points in time. And what you can see is that if you bought the inverse ETFs, that is the short ETFs, so that's going short, the cumulative risk premium that you would earn tends to be quite negative, and therefore shorting those things would tend to be quite positive. And that's for S&P 500. These top 2 are for stocks. You can also see it's the case for natural gas. But for oil, it's a bit maybe ambiguous. So it's different for different commodities, but the typical picture is the leveraged short or the inverse ETFs are ones that you not only lose the regular risk premium you would have gotten from going long, you also lose the cumulative risk premium, which tends to be the cumulative risk premium tends to be negative, and so you'd be better off shorting them. So we claim that the cumulative risk premiums beyond the variance risk premium. So remember, the cumulative risk premium starts with the second moment or the second cumulate, and it keeps on going. But we claim that the cumulative risk premiums beyond the variance risk premium are needed to explain the patterns for most assets. So keep in mind that the variance risk premium cancels out if there's no leverage, because it's multiplied by beta times beta minus 1. So if beta is 1, that's going to have 0 effect. So this what I was talking about with the Hessian stochastic volatility model is true generally, that the variance risk premium shows up particularly when you have more leverage, and it shows up kind of quadratically when you have more leverage. And then these higher order cumulants show up more than quadratically because they show up with a beta to the nth power. Um, so the that's for most assets, we think that the cumulants beyond the cumulant risk premiums beyond the variance risk premium are important, but the it's let's see if I can saying this right. He says empirically not true for most assets, but I think what we're saying is that the higher order cumulants, the variance risk premium is what matters for Euro, Japanese yen, and so forth, but not for other types of assets. And the cumulative risk premium terms of 4 and above represent a large part of the cumulative risk premium for some of the assets. For the S&P 500, it's pretty significant. It's even more significant for treasuries and even more significant than that for emerging market stocks. Now, what does that mean? I'm going to run out of time getting to the economics, but it means to me that probably leverage is important and deleveraging is important, that access to capital is important. And when access to capital is limited, which is typically when there are big moves, and then the higher order cumulants wind up being important. And typically the people that have liquidity get rewarded in those cases. So these are plots that show that market makers earn a positive risk premium for providing liquidity. Sharpe ratio is greater than 1 for several assets, high yield bonds, Russell 2000, and natural gas. So these are, I think, the rolling windows of how profitable it would be to short both the leverage long and the leverage short ETFs. And that is, seeing these pictures, it looks like it's consistently profitable. Whether it's how statistically significant it is, like I say, you can kind of argue about it. Okay. So we think that you can use the kind of first principle components of all of these things as a gauge of global market stress. And when you put it together into a gauge that Karamfil has put together, which of course would be something maybe BIS would be interested in, I'm not sure, but they should be. You see that it spikes up in 2009, as does the VIX. Then it settles back down, spikes up again in the Euro crisis, as does the VIX, settles down again, spikes up big time during the COVID crisis, as does the VIX. So it looks a lot like the VIX, and we think it's actually better than the VIX as a measure of global market stress. Okay. So if you put both the cumulative risk premium and the VIX in and try to explain the risks on these non-equity assets, you find that this short both strategy does a better job than the VIX, and in this sense kind of drives out the VIX. I would say these are kind of preliminary regressions, but they're suggesting that something is going on here. It's capturing something similar to what VIX captures, and maybe it's capturing it better than VIX itself captures it. Okay, the economic story in the last 5 minutes. So I think, and Karamfil probably agrees with me, that leverage is important and access to leverage is important. And when access to leverage is difficult, like when banks are running out of capital, when hedge funds are under stress because they're suffering losses, when market makers have built up big positions and can't really add to their positions very easily because they're running out of capital. In those kind of cases, returns tend to become very, the higher order moments tend to matter more. So the higher order cumulants tend to matter more, and they tend to be rewarded if you can kind of take a position that would be the same as the position that, say, a market maker would take, or same as the position that the bank would take, but that they can't take because they're running out of capital. So we think that this is very applicable to understanding the leverage of asset managers and hedge funds. So put options are and call options, they're all momentum assets, meaning the replicating strategy is buy when prices go up and sell when prices go down. They load positively on the variance risk premium, and they tend to have more negative returns than predicted by linear beta pricing. So we think that if you want to understand the smile, the volatility smile that you see in options prices, the fact that the variance risk premium is negative probably explains part of it, but we think that the high order cumulants might show up to some extent there as well. We also think that when you look at these factors, there are lots of different factor models that researchers put together, but some of the factors actually might have these higher order cumulants kind of automatically built into them, such as momentum factor. Obviously, seems like it's potentially got the high order cumulants built into it. But I also think that even something like a small firm effect could, because small firms might be more starved for capital than large firms. And so at times when leverage is scarce, returns on small firms might be affected by these higher order cumulants more than the returns on large firms. The flatness of the securities market line might have some of the same effect. That might be something we could explain by this, but it's just we haven't worked it out in a great deal of detail. But it could be the case that the low beta assets have returns that are higher than you would predict because they're betting on a cumulative risk premium in a particular way. There's a different from the higher beta assets. And we think that regulations are not it could be a government imposed trading restriction, or it just could be a wealth effect, or it could be a VAR limit. Or there are lots of different ways of measuring limits to arbitrage. I have a paper a long time ago with Wei Xiong where we called it a wealth effect. But whether you call it a wealth effect or bankruptcy risk or leverage restrictions or risk limits, all of these we think are potentially the fact that for example, the way I think about it as wealth effects, the fact that the wealth effects are important makes the higher order moments also kick in as being more important at times when these leveraged investors are even more highly levered and capital is more scarce. But this is just conjecture, and we need to think about it some more. So to summarize, what we're doing here is we introduce this cumulative risk premium, show that the highly leveraged strategies are exposed to these higher order cumulative risk premium terms, the higher order cumulants that describe the distribution. We think it has broad finance applications. We think it can explain risk premiums, and we think you can use it to construct a global index of market stress that's at least as good as VIX. So maybe I'll stop here and entertain some questions. So I'm finishing, according to my watch, right at 129.
Right. So thanks very much. There were some questions in the chat and a bit of an active discussion in the chat that I didn't put to you because I thought time was going to be an issue, and actually my apologies to people who had questions in the chat that I didn't ask, but I thought time would be an issue. So anyway, now we just like to invite anyone who has a question that Karamfil didn't answer to feel free to unmute yourself and ask Pete.
The Karamfil's there, right?
Karamfil's here, yes.
Yeah, okay, good. So maybe Karamfil has something to say to correct anything I said that he disagrees with.
No, I think it was summarized pretty well. I answered some of the questions in the chat, so if there's anything residual on the empirics, feel free to ask them.
Okay, good.
I think your next to last slide, the slide 25, was so something that was lingering in the back of some people's mind when they were asking the questions is, what is exactly the cumulative risk premium? It's somewhat different in the way it's constructed and the way it kicks in here. It's somewhat different than a pure higher order moment premium, in the sense that bankruptcy risk, for instance, is extremely important and is going to matter. Steve Figluski was asking about on slide 16 why the VIX was kind of the most extreme example you have. Well, the second most example you have is oil. So I'm going to leave the VIX for Bjorn Iraker if you ever talk with him about that paper. But for the oil, we know very well that bankruptcy risk was an issue in April, and you highlight that on slide 25, right? A lot of these funds had margin calls that were not able to profit from the way back, right? So if you only have the downside and then you cannot have the upside, then by construction it's going to be an extremely biased measure of whatever you think it is. Now, if you want to construct a metric of market stress and whatnot, I think it's extremely interesting because, you know, bankruptcy risk is important. If you want to position the paper as saying, well, this is better than using options, I don't know. So what are your thoughts on this?
I don't know. Karamfil, do you have thoughts on this? I think our justification was it's better than using options because the leveraged ETFs are very clean, you know, almost like polynomial bets on the higher order moments, whereas the options are more complicated. On the other hand, you could argue that the options are kind of asymptotically linear, and that gives them certain properties. But we think the options are so illiquid, many cases, that it's hard to figure out what the actual returns would be.
Yes, on that. So when we talk about options, most people think about S&P 500, and for those options, indeed, liquidity is pretty good, and it's easy to construct some of these higher moments. But if you go to some less liquid instruments like commodities, for example, natural gas, it's much harder to find reliable option quotes, and then the bid-ask spreads are nuts for those. They're above 100%. If you try to construct this
I fully
VIX,
understand. Oh, sorry.
Yeah.
I fully understand this argument, and I'm very sympathetic, but I would argue that they are complement, not substitutes, in the sense that, you know, those assets for which you don't have good options are probably those assets where the levered ETF is also going to have the most bankruptcy risk, and then the tracking errors might be dominated in some periods by, you know, issues related to this, and then it becomes unclear what exactly you're measuring, in my humble opinion. But you know, it is. I mean, all this. I mean, this is a second order consideration in the sense that the methodology is great and it's really cool that it's out there. And it. I mean, what I'm saying is just, you know, in some scenarios, it's capturing things that might not be the first thing you think of when you think of higher moment risk premium.
Oh, it's certainly.
So we might think. Let me just on the tracking error and then the bankruptcy. So you can think about this. There is somebody else on the other side who is exposed to this bankruptcy, who is providing liquidity to the ETFs and is bearing this cumulative risk premium, and that somebody is gonna charge a premium for that, and that's reflecting the tracking error. So you don't get 3 times the return; you get 2.8 the return, because whoever's in the other side is bearing this cumulative risk premium and is charging you a premium for the liquidity provision, which is reflecting the tracking error. So you can think about this cumulative risk premium in terms of it's a risk premium that liquidity providers are charging, which is reflected in the tracking error of the ETF. And that tracking error can become nuts at times of stress, like the oil episode in April 2024, because there is nobody else on the other side. So the risk premium for providing liquidity and bearing this cumulative risk is just enormous. And that's reflected in these huge numbers for all that you see there, at least minus 54%. So the bankruptcy risk is higher if you have high leverage, undoubtedly. But even if you look at the 2 times leverage and minus 2 times leverage ETF that did not go bankrupt in that episode, they still have pretty high cumulative risk premium.
What about the fact that these ETFs trade below their net asset value because of the transaction costs? Does that create any problems?
So we use prices, not net asset values here. And whenever there's a difference between the two, there is authorized participants to correct the difference between the NAV.
Let me ask this question in a slightly different way. I think I heard Pete say that in a log normal world, there would be no cumulative risk premium. I hope that, let's assume that's what I heard him say. But the ETFs incur transactions costs. So the ETFs should, you know, would underperform in a log normal world anyway.
So they would then perform under the physical measure and under the risk neutral measure by the same amount. So the difference between those two will be the cumulative risk premium, which is 0. So you can think about the physical underperformance of the ETF because they have this drag or volatility slippage. And that thing is the same in the physical and the risk neutral world. So there is no cumulative risk premium. So our estimates would imply 0 cumulative risk premium, 0 transaction costs.
Okay, then there's a question in the chat from Catherine Shalin that you probably that came a little bit late. The VIX is also a mix of expected moments. What is the difference between the VIX and your index? In what way is one or the other index a better gauge?
So that's something about the last slide where we show this fear index. So the benefit of our index is that it's based on all asset classes that you see on this slide. So it's not only desk 500 options, but also commodities, currencies, bonds, high bonds, corporate bonds. And we take the average return of this short ball strategy across these asset classes. So basically we put ourselves in the shoes of a liquidity provider who is trading globally across markets and is providing liquidity to all these ETFs and is exposed to cumulative premium in every other asset class. So in that sense, our index is taking a more global perspective. So that's one difference. Then second difference is that we have this cross-sectional asset pricing tests in one of the slides where we show that our index captures better the risk premium of non-equity asset classes like options, CDS, FX. Whereas, so when we put VIX and our index in the same regression in cross-sectional asset pricing, our index is driving out VIX for non-equity asset classes. So that's the second benefit of the index compared to the VIX.
So that could be not as grandiose a claim as it sounds, because the VIX is more based on equities, and our index is based on all these things. And so it's not surprising in some sense that it explains all these things. Probably if you used our index to just explain equities, the VIX might do better, right?
Yeah.
So yeah, but if you're interested in forecasting global stress, global stress comes from equities, yes, but it probably more comes from bonds, and it also commodities are very important. If you look at the history of recessions in the United States, there's a huge one in the 70s that was related to oil, and there's a huge one in 2008 that was related to mortgages. There was a huge one in 1980s that was related to inflation. Also had maybe an equity component. The 1990s one was related to banking. So a lot of these episodes of economic stress aren't strictly speaking equity things.
Well, thank you, Pete. I know that you have a hard constraint very, very soon, so I wanted to step in and thank you. We can continue to torture Karamfil after you're gone.
Okay.
Thank you so much for this insightful talk, and thank you everyone for joining us after so long. When we don't see you for a couple of months like this, we're always kind of worried that you're not going to be back, but everybody's back, so we're really happy to see you, and we hope to see you again on the 25th when Julian Terstegi comes and talks to us about his research, and then we'll have Che Arsenalai, Jefferson Duarte, Michael Johannes, Christopher Schwartz. So really a lot of fun stuff ahead. So thank you again.
All right. Well, thank you so much for inviting me, and I appreciate the opportunity to talk about this paper. I'll see you later. Y'all are going to miss the slides once you miss me, right? So, I guess.
I can share the slides if they have questions.
Oh, you got slides. Okay, good. All right. I'll see you later and let Karamfil take over. Bye-bye.
Hey, thank you, Pete.